Hey, good afternoon, good early afternoon to everyone. I think this first slide's fairly self-explanatory, but I was updating some charts and thought I'd share. Overall, we're a little bit behind, not very much. Corn's about 20%. Normally this time of year we'd be 30, 35, pressing 40% complete. So we're a little bit behind, just getting started here with grain, sorghum, and soybean harvest, but I don't think anybody would complain about the moisture that's kind of kept us out of the fields as long as it passes through today and things start drying out a little bit. Basically, I want to kind of, and given the fact that we are in harvest, I kind of want to focus most of my time on post-harvest decisions. But real quickly here, I kind of want to take a quick look at where we are pre-harvest as we're going in, just in case we've got some sales that we might want to make. Um, that we might want to make. Um, for grain or oil seeds that we would, we can't store, right? I gotta sell some, maybe set a price. And this is the chart I've shown multiple times. It's the December corn chart. Basically, within our winning the game plan, we've priced about 40% at those three locations that I've got marked. And last month, we kind of drew that line there at about 430 and kind of said, well, that's been sort of an area of support earlier in the year. Here late in the year, it's become one of resistance. And since our last time in August, we did bump up there. We did not get up into the 435 range, but we sure did get past 430. So I don't know if anybody took advantage of that and maybe did some early sales. We've backed off of that. I think we're down a little bit. And we'll see where this goes. We might do another retest of this 430. Soybeans, very similar type of chart. We're about 30% priced at those two locations back in June, and then in February that we priced kind of a cash price roughly of 988. Again, we kind of drew that line at 1060, said, hey, boy, if we could price at 1070, well, the market never got up to there. And so we really haven't had an opportunity. And so that's kind of where we stand. But so as we move forward and we start thinking about pre-harvest or post-harvest marketing, I kind of want to just share real quick some of my assumptions that as I put together estimates of cost of storage, et cetera. Here's what I'm using, right? Now, typically, in a 5-year average or last 5-year average, Kansas is 75% harvested with corn by October 14, 75% bean harvest done by October 24, and grain sorghum by October 30. Again, we're running a little bit behind. Some good clear days, so we might be able to catch up with that, but that's a 5-year average. Estimated storage costs typically begin 30 days after that. So when I'm calculating, storage costs, I'm beginning on corn November 15, soybeans November 25, and December 1 for grain sorghum. Estimated storage cost, typically what I'm using right now is 7% interest, a lot higher than we've used in the past, but we've seen interest rates run a little higher. Commercial monthly, so if I'm looking at just monthly charges for commercial storage, roughly 6 cents for corn and grain sorghum, 7 cents for soybeans. If we're looking at on-farm storage, we're looking at a 1% shrink and then a 5-cent in and out charge, right? Just the labor, the time, everything to do make that work. So, typically in my charts and things, on farm, there's that quick bump because you got all these upfront costs, but over time, on farm storage obviously is going to be much cheaper. So look, the first thing we want to look at when we start thinking about, post-harvest marketing is what's the carry in the market, right? So I looked at it yesterday. December was at 426 and a quarter. March was at 443. So that was a carry of 16 and 3/4 cents. And if you break that out, per month, that's 5 cents, 5.6 cents. Going to May, it was 9 cents and be 4.6 cents. So basically, and then below that in the gray area, I've got estimated monthly commercial storage costs of 8 cents a month. So again, really the carry in the market is never covering our commercial storage. Doesn't mean it won't cover on farm, but it's definitely not covering commercial storage costs. Same thing on the soybeans. I'm looking at roughly a 12 cent, almost 13 cents for estimated commercial storage costs. That's at 7 cents plus 7% interest on the value of that grain right now. So again, we're not covering that either. This chart, right, this table basically looks at cumulative, okay, carry. And so I looked, let's go on the far left of that screen, July 1, the difference between the March contract and the December contract was 16 cents. The difference between May and December was 26 and 3/4. Between July and December was 35 cents. As we moved into August, that July carry going clear out to July was 34 cents. In September, it was 33.7. And then we get into yesterday and it was 0.31. So bottom line is we're starting to lose a little bit of this carry. But I've got the calculated costs there too. So for March, I'm looking at storage calculated through the third week of February, and commercial storage cost would be 0.269 cents per bushel. On-farm storage cost 0.16. The carry is 0.16. So basically, on-farm storage would carry or would break even. But look over there in the circle. On-farm storage, even the carry is kind of covering that right now. And really, we're seeing the same thing on the soybeans. We're seeing that on farm, the carry in the market is covering, the storage costs for on farm, probably not the commercial storage side. The other side of this equation, and the one other point we want to look at, is basis. Definitely local basis levels are favoring storage. Feed grain basis in particular is extremely weak. Now, what I've got charted here is three of them, same location, Haven, Kansas, sort of a south central location. I've got corn, grain, sorghum, and soybeans. But the corn and the grain sorghum are much, much wider than normal, right? I've got the current year, I've got last year, I've got the 3-year average and the 5-year average. And again, on the feed grains, we are much wider than normal. Roughly on the corn, 40 cents wider than, say, the 5-year average. So that's incredibly wide. Soybeans basis is weak. So it's not extremely weak, but it's weak. It's right in there with about last year, pretty close to the 5-year average. So again, pretty weak basis overall. This encourages storage, right? The market's kind of saying, hey, we don't want it now. If you can put it on the farm, if you can store it, do it. Now, obviously, people need to check their own basis. This is one location, South Central Kansas. It's not the end all be all. Depending on your location, whether you've got feed yards and crush plants, if you've got ethanol plants nearby, if you're located near a terminal, your basis could be much different. So take a look at what your local basis is. But I'm making the argument here that feed grain basis is very weak, and soybeans is weak. So how does this kind of progress into looking at, what my options are, how well storage will pay, say, for corn first? And so this table, again, I've shown it many times. I've got 6 locations across the state. Now I'm looking at July corn futures. So I'm looking way out there. I'm saying, hey, what if we would store until about the third week of June? You could also run this and throw in the March futures there and storage costs into February. And often I do that. This time I'm going to go a little farther out. But the July corn futures yesterday closed at 458. Colby corn was 386, so the deferred basis was 72 cents. Now, the 5-year average for Colby is 9 cents under. So that would give us an expected basis appreciation of 63 cents. And I'm just going column by column here. Commercial storage costs through June in Colby roughly would be 60 cents. So expected storage returns for commercial storage is 3 cents. On farm is 37. So again, you kind of look at that blue area versus the green. The on-farm storage really looks good, right? Looks like it would really pay just on basis appreciation alone and coming back into that with that carry in the market. Now, one thing remember I pointed out, currently feed grain basis is 40 cents weaker than the 5-year average. So you might ask, well, what if? Because I've shown this many times. I'm not going to show one of the charts, but typically when basis is very weak in 1 year, unless something drastically changes, that's going to carry. And so we're going to continue, likely continue to see much weaker basis even into 2026. That would be a big concern. So let's plug that in, right? So if you look across there at Colby now, instead of 9 cents under, I'm using 49 cents under. Now, when you do that and you throw that into there, clearly for no location except maybe Chenew's kind of break even, but commercial storage, no way. But the on-farm storage, even in this extremely weak basis appreciation, still looks like it's, doesn't look too bad at all. I mean, it's making you 15 cents. So for the six location average. So Colby, it wasn't covering it. So, kind of that northern part of the state, a little tougher if we don't see a more normal basis appreciation. But again, that is a very that bottom table is a very conservative view, and it even largely suggests that on-farm storage for feed grains could pay. So what are my other marketing alternatives, right, for corn? Now I'm kind of zeroing in here using that South Central example. So my local cash price, let's say it's 381. And again, I'm throwing in July futures. I'm 458. I'm looking at July calls. But if you sold the grain and said, I'm going to go ahead and buy a call. So that'd be that column B. That call yesterday would cost me 28 cents and I'd have a minimum price of 353. So I could sell it and get 381. I could sell it and buy a call, have a minimum of 353. If futures prices, July futures, get above 489, I start gaining then on that position. The other thing we could do is what I call a bull spread, where you're buying the at the money call, the 460 for 28 cents, but you're selling it out of the money call, which kind of caps your gains for 15 cents. So now I'm in this market for 14 cents, almost 15. I've raised my minimum to 366. Now, again, typically I would be throwing in a March. And if I did that, a March 440 call was 18 cents, giving you a minimum of 361 versus that 353. And if you did that column B using March, maybe you grabbed a 470. They were running 8.5 cents yesterday. So you're netting out at about 11-cent cost, right? So you can get into that a little bit cheaper and a minimum of 370. So, maybe if you're really going to do that B or C, you probably want to use a March and then just roll it if you decided to or not to. And the other advantage there is by using that July, it has a lot more time value in those options where the March options would not. So probably advantage would be in those call options to be using March. But let's go focus on that column D or the last half of that thing, storage. Now, again, I've got that expected basis at 38 cents under. That's that 40 cents below 5-year average. Again, for this location, your expected price would be 394, 13 cents better than just selling it. So again, the market's kind of telling us that post-harvest storage looks like it should be profitable. But again, a storage hedge would mean you're needing to sell July futures, right? It's a storage hedge. The only way you're going to make money on a narrowing of basis is if we sell futures. Now, something I might add to this whole alternative, this D, would be this. If that conservative basis estimate, 30 cents, 8 cents under from that previous slide, holds, the storage hedge would give you 394. But what if I'd sell a call option, right? If you sold a 490 July call option, you can do that for 17 cents. That increases your net cash sales price to 411. And the call would not turn negative until you hit basically above $5 or 507. So we need to see a pretty significant rally, right, from where we are now up to a 490 and really above 507 before you would be worse off. So that might be something to consider. It's not a recommendation, but I think it's another thing to consider to kind of get that minimum price a little bit higher if you're putting on that storage hedge. Now, turning towards soybeans, again, here's that table with all 6 locations. And again, I'm using July and looking at the idea here of the 5-year average basis. So a pretty weak basis. But again, we were running closer to that. So I think that's maybe something we will see. Again, commercial storage, that blue section, doesn't really work. But on farm, for the 6 locations, the 6 location average is 14 cents. Garden City, it wasn't working. That'd be the Deerfield location. But for the rest of those locations, it looked like there'd be a positive return to a storage hedge. Again, meaning I'm selling July futures, hanging on to that grain on farm. If we look at our alternatives, again, I'm looking at July, calls, etc. They really jack my minimums down versus, because if I sold today, I could get 930. by buying that call for 55 cents at 875. Now, again, the point is there's a lot of time value. I could go in there and buy a 1040 March call for only 41 cents, give me a minimum of 889. A 1090 call, so moving into that C, could give me was 22 cents, 23 cents. So that'd be netting an overall cost of only 18 cents to get into that overall position. And my minimum now is at 912 as opposed to um, well, it's 913. It's not too bad. Okay. The storage, though, again, 18-cent gain, expected profit there in that lower right-hand corner. So again, on-farm storage for soybeans looks like it would work. Now, I think when we look at feed grains versus oil seeds, generally speaking, if space is limited, I can store one or the other. To me, I think overall this probably favors corn over soybeans, but I think, storage would work for both, depending on what you're at. But again, it probably needs to be on-farm storage. Now, I kind of want to roll over here real quick and take a look at pre-harvest wheat. Plan implementation. This is the chart I shared last August, or yeah, last month. Again, not a big change, right? Since August, we're kind of back to where we were, maybe even a little bit lower than where we were the last time we talked. We did see that rally up to about 570, but then we kind of fell short again. But I kind of I throw that line in there at 620 and say, I would argue or suggest that maybe 610 would be a target. Although when we start looking at our options, or not options, alternatives, let's say, right? July wheat futures were 560 and three quarters. Colby, the forward cash contract was 490. Garden City, 490. Concordia, 505. South Central Kansas, Haven, Producers Ag, 501. Incredibly low, right? The six location average of a forward cash contract bid was 497. That's basically covering direct costs, or my estimate of direct costs. Wouldn't get you cash rent, wouldn't cover family living. So definitely would not recommend doing that right now. Let's see if we can get prices higher. But even if we throw in there and say, well, what if we could get up to that 610 futures target equivalent? We're still only at 546, which means we're still not fully covering even cash rent on top of my direct costs. So right now, this market, it really isn't offering us very many opportunities. New crop basis bids on average are 25 cents weaker. And not only is the basis bid weaker, but we're seeing incredibly low futures. And so we sure would want to wait and give this thing some time, see if we can get some opportunities between now and say February, March, get into spring. Hopefully we'll see this market pop back up. With that, I'll say thanks and turn this thing over to Dan and then help out with any questions if we have any.
You all have been sent out presentations. And I really appreciate Mark's coverage of the uh, of the cash side, especially, and looking forward to what's bound to be our situation in coming months. We'll be looking at storage options, probably whatever we don't sell at harvest, unless we're really surprised. We'll be in the issue of trying to decide when to, and probably with the mindset of hitting singles and maybe doubles in terms of gains that we'd hope to see in the gray markets. I would say that maybe it's just because I've lived in Kansas long enough. I distrust that we'll always have great weather. That and here we've had have a tremendous crop production year this year. That's the issue of uncertainty that comes in the grain markets, and that the factors that are leading us to more than adequate rainfall in most cases, and large crops tend to vary year by year. So I guess I'm not of the same camp that would think that when we're down, our prices are down right now, that they'll always be that way for the next 5 to 10 years. I think we'll have uncertainty, and the first set of uncertainty that come into play will have to do with, of course, trade actions, but also just weather in South America, where our major competitors are, particularly Brazil and Argentina, and we'll watch where that goes. So let's go on. The last time we met on one of these, we talked about trade issues with regard to U.S. tariffs, and I think along with large crops, the uh, concerns about trade have tended to be tended to mitigate much enthusiasm for the markets. Although we've had very strong corn exports in the last several months, wheat, especially hard red's been going quite strong with regard to exports. So we talked last time we were anticipating, well, there sounds like there's some legal actions coming with regard to U.S. tariffs, and that certainly has come about since the last time that we'd met. Retaliatory tariffs versus the U.S. I don't know that we've seen that effectively done so much, but we certainly have seen other protective actions by countries, deliberate choices on the part of China and some others to buy from other suppliers whenever they can, especially China buying soybeans from Brazil and elsewhere. Grain sorghum's taking the major brunt of this. Also, it's our misfortune this year to have a decent uh, grain sorghum crop in Australia, so that's worked against us on sorghum. And also, you hear now of other countries. I believe India, perhaps being approached by China to sell them some of their grain sorghum. So, anyway, I think that not not so much the case of retaliatory tariffs coming in, but really just protective actions on the part of other countries. So we'll see how all that plays out. And then there is this question of what is a good tariff to have? You know, is it X%? Is it targeted towards certain commodities or not? That's all in play. In the bigger picture, the issue of tariffs and their impact on U.S. trade and the optimism of U.S. markets sure seems to be in play. We look at weather. I think you look at this first chart here in the upper left, surface soil moisture. This is a drought indicator. It's kind of an indices of a number of different sources of information. You can see in our part of the United States here in Kansas, lots of moisture, and I'm not even sure that accounts. That's only September 22nd. We've had moisture since then, especially in parts of northern western Kansas, but pretty dry in parts uh, well, right in heart of Illinois and parts of Iowa, Missouri, Indiana, and Ohio. And you look at the root zone moisture, a little more of a long-term indicator. You again see that central and eastern corn belt having some impact. So I look at this and I think there's still uncertainty with regard to what final crop yields will be, especially for soybeans, as these dry conditions have been in existence for the latter part of that crop's growing season onto maturity now, and so we'll see where all this goes. But there's still uncertainty about where yields will finally come in, and we'll talk about that more later. Moisture deficits again in the green. Anticipated moisture through October 1st. Very, very wet in Kansas. Pretty dry in a lot of these other major growing places. So Kansas and North Dakota, South Dakota, parts of Nebraska, all having quite a bit of moisture. Pretty dry elsewhere. And when you look at the whole world situation, this is how our moisture situation, our moisture conditions look compared to the rest of the globe. You can see that same area of wetness right through again the western corn belt up to the northern part of the western corn belt. Pretty dry parts of Canada. It's impacted their crops some. Really more than adequate moisture in Argentina, southern Brazil, in the central part here where you see again Mato Grosso, some of the key growing areas, no drought. In fact, more than adequate moisture. So just again, overall large crops coming out of South America, and that's affected the markets. Then you have this situation. You have all the dryness that's occurring up in parts of Ukraine, parts of Russia, and also reports of major financial issues going on in Russia as they try to finance their war effort. I'd read an articles, seen information that they have uh, uh, interest rates for farmers of about 25%. And some good friends of mine talking about some of these things here of late that you just see a whole lot of challenges coming out of that Black Sea region, particularly for Russia. So you wonder if some of the strength in U.S. wheat exports of late probably well-informed people that look around to see where they can get their wheat supplies from around the globe, and it looks like this key area isn't doing the best in terms of supply availability. Ups and downs in China and India generally don't hear of major problems right now. There had been some throughout the year, so don't know if that will drive things. And at this point, gracious, it looks like Australia has more than adequate moisture, and of course that's positive for the crops they produce and provides export competition for us. We'll take a look at feed grains. Um, as Mark more than adequately covered the cash market side, so I'm going to focus on the to complement what he had done. I'm going to go ahead and focus on the futures more so, and I have cash slides in here if you want to see the presentation, but we'll go this way in the interest of what we can best accomplish for you here today. So anyway, you can see that the movements in the this would be D's corn futures, and you see that we'd fallen down to about 932, 933. At one point in the summer, it jumped up, trended higher to about $4.30, 432 thereabouts, 431, 32, and then are now just sort of thrashing around ups and downs at about 426. I try to follow, pardon me, the relative strength indices as a quick indicator of relative positive momentum in the market. So for D's corn, we during this downtime, you'd see we got down to on a scale of 0 to 100 at about 25, and again you can see that's been sort of at least a psychological barrier apparently for the market in terms of where we had been at. So on lows we got down here, and highs got up getting closer to 70, 75, and since that time we're just sort of in neutral, and maybe that's where we'll stay with regard to where harvest pressures where we'll go during the harvest. I think upcoming USDA reports, next one being October the 9th, for crop production will be a big thing to consider. Also, next week on September 30th, there's a grain stocks report that will provide more information. For corn, grain stocks report for feed, all these crops stocks report. But then for wheat, there's an annual small grain summary report that'll come out. So the wheat markets is more vulnerable probably than these other markets to volatility coming out of that report on the 30th. I think that's a Tuesday. And in terms of long-term perspective, we're certainly off of the highs we've seen periodically in the corn markets. Again, tight supply demand, financial shock, an election coming up. Remember, a lot of you remember that in 2007, 2008. Pretty tight stocks heading into 2011. Then the drought of 2012 came in, shot us to record highs. Came down off of that with good crops. Have tended to move sideways, really in a range of about 325 to up $4 most of the time, a few times hopping up to 425, 450, and then came out of that after a low of 309 in 2020, jumped with COVID had an impact on all these markets, but even more so, the Ukraine-Russia war jumped up to the high side. The world was really concerned about, extremely concerned, UN getting involved, other countries, to make sure flows of grain kept coming out of the Black Sea region, came off of that and are now down in this area again, 385 for a recent low, and spending a lot of our time between 4 and 425 right now. So I guess to stand back and look at these markets and to gain some type of perspective, long-term perspective, we're we have record high corn coming in. We're sitting at about 425. Our cost of production is higher here than it was back there. So arguably 350, 375 then is probably about equal for us profitability wise to 425 right now in terms of D's corn futures. And are really waiting. I think it's fair to say we're waiting for something to change the supply demand balance algebra that we've got in the market. And right now we're seeing large crops coming. We will fiddle around the edges probably in terms of what the final yield will be, but we're until the next big issue happens in the market. It's probably be a crop production oriented issue or possibly a geopolitical one, but probably more a crop supply issue that it looks like we're in a mode where we'll be watching for storage opportunities coming from now until at least we get our own crop risk coming in out in the spring, and maybe in between that, what could happen in South America for plantings. And the futures are, if you look at managed money traders, where their positions are, they are generally having more showing more bearishness than positiveness. But it's always interesting to stand back here and look. We have been at times in 2024, we were more bearish in terms of where traders were putting their monies at. On the red being their sell positions to the tune of about 2.5 billion bushels worth of short positions, sell positions, as opposed to about 800 or 900 million of longs. Well, now we have just after having that pretty good optimism here earlier in the spring, came down off of that. Now we're about 1 billion, 1.1 billion for long positions, and for the shorts about 1.8, 1.9. So we're just kind of bearish, but we're not fully committed bearish, I guess would say. We're still there's still questions about where the markets may go. It's interesting that the USDA has projected for this marketing year an U.S. average price of about $3.90. When I look at and that's basically, I figure that by taking whatever cash. Well, at this time we're looking at cash prices. The cash prices that work their way through in terms of having something in hand versus what we project with futures and the basis levels, and the projected season average price with futures at their current amount, and that'd be here in the this black line. They're more along the lines of about $4.22. So if anything, it looks like the USDA's numbers are moderately more bearish than what the futures markets are stating. And of course, that $3.90 figure that is the official number used for farm program payments. I think it's what PLC uses for their calculations. When we start looking at reference prices for ARC PLC, that's the official number. So we'll be watching where that goes. But the futures are slightly more optimistic than the USDA, and if anything, this purple line is the season average trend, and if anything, the futures right now are under valuing. It seems like they're again, this is projecting out into the 2026 season, so this would be this is where we're at right now, September 25. This is all the way out to August 26. The futures are probably underestimating the a little bit anyway, the volatility and potential price rises that would happen in the spring. So Mark, that comes right back. This comes right back to the storage issue. So we're looking at futures storage hedges based on what the futures are offering, and they're tending to be pretty conservative at the moment. So that doesn't mean we ought not to do storage hedges, but I think your statement of looking for opportunities that could drive those deferred futures higher isn't that far out of line in terms of expectations. Any thoughts on that, Mark, before I run on?
No, that's a good point. That's a good point.
Okay, okay. Let's see here. And in without belaboring this, most of you watching the markets know what happened in the September crop production report that the USDA raised the corn acres estimate. In August, it was 97.3. Now it's 98.7 was the earlier September number came about, and it's 98.7 record high. Highest we've had before was back in actually 2012, 97.3 million acres planted, harvested 87.4 that year. Our the 90 million acre figure definitely to the high side, well, highest we'd seen. So the farm we're turning it looks like U.S. farmers are turning towards their comparative advantage in that we really grow corn well. And under risk and uncertainty, particularly out of South America with what they're doing on soybeans, with our ethanol on the one hand, livestock feeding on the other, and also now pretty strong exports. We're growing corn. It makes you wonder where will we go next year. Corn yields. This figure was U.S. corn estimated yield was like 188.8 bushels per acre out of the August report, scaled back now to 186.7. If the acreage wouldn't have changed, that would have ended up and brought us, we'd be looking at projected ending stocks at below 2 billion bushels. But we as the acreage moved higher, it really it offset more than offset the lower yield, et cetera. So question going forward will be, and you'll see this in a minute, uh, where what do we end up with for a final figure? We could end up with this, probably a coin flip or so. That would be fine. But it could just as easily be something less to 184 or thereabouts. 184 would still be a record by about 5 bushels an acre of what we'd ever seen. And so now we're projecting 16.8 billion bushels of corn. Haven't been within 1.5 billion of that, or at least a 1.45 billion ever before. So in a way, if all else was equal, it's really surprising that we're still holding above $4 for corn, given this mass of corn we're anticipating supply side coming into the market. And if with that, to offset that large crop, we've got levels of usage that are either equal to or above what we've ever seen, particularly for this anticipated projected by the USDA in the September report, 6.1 billion bushels of feed usage. The highest we'd ever seen before was 5.9, just about equal to the record high of for ethanol usage, 5.6 billion, just a hair higher, and 17-18 exports. Highest we'd ever seen is 2.75. Now we're projecting almost 3. Ending stock, pardon me, wet corn milling, so-so. If anything, sideways to slightly lower, it's actually the wet corn milling side because of dietary issues here in the U.S. And so if you shaved off 1 billion bushels off of feed usage, well, say 2, just match that. So 2 billion there, and left ethanol unchanged. Exports took 1.5, so 2.5. So you've got the 1 billion, yeah, 2, so about 4 billion bushels off of that. We'd be looking at, if we just went to our historic highs, we'd be looking at 2.5 plus billion bushels of corn, which would be all that much more bearish. So when we look out to storing corn out into the coming months, out into May, again, spring, early summer of next year, it will be watching to see if we attain these high projected usage levels, because they're out the top of the ranges we'd ever seen before. So that's that. I mean, I hope we see that personally, because I like to see the usage industries do well. But if we don't, that's really a red flag and a warning that in these markets that we are really bullish on usage, and we'll see if we get there. Exports, just wanted to show you this last marketing year, 24-25, we finished out as the very highest we'd ever seen. 24-25 marketing year. We'd never been that high before. And then now we're starting out on the high side again. Global corn bids, the U.S. bid is in the green. So we're ourselves in Argentina about our Argentina the lowest bid, the U.S. just a bit above that, and you can see these are in terms of metric measures. So interesting. It's interesting how the Ukrainian bid, I assume a fair amount of that probably going to Europe largely and elsewhere, has dropped off so much here of late. And who do we sell it to? Mexico, Japan, Colombia, South Korea. You don't see, and this is in the last marketing year. China's not on there. If you go to the previous years, China was buying more corn. And what's projected now for this new marketing year that we're in, the 25-26, again, Mexico, unknown buyers, that not exactly sure who that is, Japan, Colombia, et cetera. Again, China not there, and China and the U.S. are having these trade discussions. We're in a 90-day window. We hear good reports stated by the U.S. administration, but U.S. grains, pardon me, not being mentioned. So the markets are watching that. So far, China's not a direct player in the U.S. corn market. They're not a direct player in the U.S. soybean market, or the U.S. grain sorghum market, and that's an issue for us right at the moment. Corn stocks, there's a 2.1 billion bushel projection. I'm kind of tipping my hand. I think there's about just under a 45% chance of that happening. So it's about half, but still seeing the trend towards lower yields coming in and potentially affecting us. 13% stocks to use. 13% stocks to use, 390 as a price, and if the USDA projection of 186 bushels an acre, basically 186, 187, which be a record by about 7-8 bushels of what we've seen in the past. If that doesn't hold true, and we only have a record of 184 bushels per acre, then everything else the same, unchanged, you end up with a ending stocks about 1.8, 1.9 billion bushels, and it would make about a 35 cent difference in price. This is a caution out here at 1 in 20. If we get 184 bushels an acre, and that in my thinking, I would lean towards that more so, and then you start to shave, and if we don't attain that ethanol or export number, take 100 million bushels off of that, then you mitigate some of this gain. Now I can see already here that some of the sharp, I can name the people on here as I've looked at the roster who have already said, okay, O'Brien, I think that only adds up to let's see, 75. 5%. I think that last one on the outside is supposed to be 25%. So I missed a number there. My mistake. And U.S. the world less China supplies of corn aren't overwhelming. In fact, this crop year we just came out of was at least a 19-year low, and we're just slightly above that. So the grain markets, even in light of pretty tight world stocks, it's kind of a situation where if I have it now, I'm not going to worry about it. We're not focused out on future risks as long as we have what we have in hand, and I guess that's just the way we are, and I think you see that when you look at the futures contracts and the volume. We're very front loaded on futures volume, and a lot of algorithm trading involved. So we're focused on today. Tomorrow will take care of itself, apparently, in the grain markets. Okay, and you can see world stocks to use, world less China stocks to use generally still trending pretty tight, and this differential still being between 104 and 281. All that would be Chinese stocks. This is actual world stocks outside of China, and that's counting on a crop that's not even planted yet in South America. that comes in spring months. Just did want to say something about Mexico. Mexico's important to the United States. So here you've got the imports of Mexico outstrip the amount of corn that they produce, and this is their total usage. So they're bringing in about half of the corn that they're needing. So it's pretty important that the U.S. continue to have reliable trade relations with Mexico. And one thing to note here, you can see the jump up in their feed usage, and I think fellow it's on this call, Ward, sent this question in that is, with disease issues, insect issues, impacting the flow of feeder cattle across the border from Mexico into the United States. Are we seeing feeding going on down there? And then the cattle walking across the fed cattle or the beef coming across rather than the feeder cattle. So these numbers with feed usage in the brown orange would tend to support that hypothesis. Ward, if you're on here. So, and Brazil, the issue with Brazil is again, they have their exports. Note their domestic use is jumping up. There have been reports here of late, and and especially down in here, you can see the food seed industrial usage amount of corn in Brazil is expanding a fair amount, and we read reports of that here recently as well. So, to some degree, Brazil I guess I'd ask the question, will Brazil find themselves like the United States to where their domestic ethanol usage of corn starts to compete with, and to a degree crowds, I wouldn't say crowds out, but crowds their export numbers. If that happens, then that has probably positive implications for U.S. corn exports on into the future. And it'd be these numbers here. So in the last 3 years, 21.5 million metric tons to 28 to 29 and a half. You've got the food seed industrial usage is largely ethanol in Brazil starting to jump up. So need to keep an eye on that. And that actually bodes well for the competitive position of the United States in corn markets, because Brazil is our major competitor. And I did want to mention for grain sorghum that we did see out of that last report, grain sorghum acres moved to the higher side, added about 40,000 acres. And of course, sorghum food seed industrial use, sorghum exports are struggling. It's a fair question that if we were looking at about 95 million bushels of U.S. grain sorghum exports in the last marketing year, and if we're projecting 225 in the next one, we are counting on a resumption of strong exports for sorghum, and that will have to be China coming to the table and resuming what they had done. That may or may not happen. So these trade talks between the United States and China are a big deal. One thing that the USDA ERS people are talking about, and saw them in person here last week in Manhattan, was that in the last several weeks that the usage of sorghum in ethanol production has been strong. So it makes sense that here we have wide basis, Mark, as you'd mentioned, for sorghum, and really lamentably so. Tough situation. But eventually sorghum gets to the place where users in either livestock feeding or ethanol or international exports, they start looking around in order for them to make a profit, that sorghum ends up being a pretty good deal. And so I guess if there's a banner I could put over sorghum, it's that perhaps the best cure for low prices is low prices. And in that it would help eventually to see the movement of sorghum come in and be a lot stronger. But we may not see that really until we get new crop in, and we'll see where its main competitor corn comes out and where what people do then. So we got a few minutes left. I'm going to hit on soybeans and then say a little bit about wheat. For beans, uh, the last time we talked, I think we were just looking at this run up in the latter part of August in the soybean market. Since that time, it had been ups and downs and fell off here of late. And again, a lot of this discussion has to do with trade talks, is my understanding, in terms of the market not seeing what they view to be tangible progress between the United States and China in dealing with the um, trade issues that are at play. The United States farmers, of course, wanting to see much more progress. And this number, instead of 1049, it's 1012. 1049 is where we closed at where we were at in August. We were trading about up in here. Now we're about 1012. So I guess that's about 40 cents worth of just so to negative news in the soybean market. And again, similar to corn, when we got really rough with beans in 2018, 19, 20, we got as low as about 818. Spent a lot of time around 850, or around $9. Here, just after the run up, come down to about 947. That was in the that would have been late 2020. 25 well 24, pardon me, and now we're at about $10, 12 cents, et cetera, or around in there for a price. So we've certainly seen worse prices, but we're just so right now in terms of prices, and looking for something to take us out of well, with harvest coming on, we're looking for some type of usage news, or maybe a little lower yield than we had thought, to perhaps give us some benefits in the market. And you see it here too. Managed money traders really equal short and long, just sort of treading water, not a lot of movement at present time. The market projecting about 1050 again. For prices, the USDA price is about $10.10. So again, take that for what it's worth. It seems that the markets, with the carry out into the future on the deferred contracts taken into account, projecting a little bit higher than what is probably more of a front-loaded USDA in their projections. In that, would say also in that. In the August report, we were looking at about 80.9 million acres. The September report came in at 81.1, so a little bit of an increase in acreage, and certainly not the highest amount of soybean acres that we've ever seen. The yield figure shaved down about 53.5. We'll see. If anything, you would wonder about one or so bushels coming off of that figure. That would be positive for the soybean supply demand balance sheet. And again, you can see where production is coming in, not outlandishly large, sort of in the ballpark of where we've been of late. Soybean exports this last year, just really the 2024 figure in the black, just so really, starting out decently in this marketing year so far. U.S. export prices in the red, the lowest of Brazil and Argentina. And I would say on this, again, China, main buyer, 60% of world soybean purchases, coming to these other locations first. We're the last option that they have right now, at least in our current trade agreements or trade status, and it shows that we have the weakest export prices that are occurring. We've talked about this before. Generally, the USDA's projections and final numbers for exports moving to the low side, projected at 1.685 billion bushels for this coming marketing year. That's the lowest we've had since back in 2019-20. So China going elsewhere. That's just the way it is. And domestic crush for renewable fuels for beans growing, projected to grow even further. So we're with what our current trends, we're turning the soybean usage into more of a domestic market. That's what's happening, and because of these various geopolitical issues, we're moving out of the export market a bit in soybeans. Uh, U.S. soybean stocks, again, 300 millions, about 7% stocks to use. Really nothing that's much different than where we've been. A little bit lower. Projected price $10. So again, there, I guess if you're sailing a ship and you get to an area in the ocean where there's no wind, you're just sitting there. They call it the doldrums. We've got the doldrums going on in the soybean market. There's just not a lot to move things around. And what could change? Again, instead of 53.5 bushels per acre, take a couple bushels off of that, and with the same acreage, et cetera, you take ending stocks to 300 million, you're down closer to 200, and uh, we're tight enough here with these stocks to use that here from almost 7 down to under 5. That's a fair change. So, Mark, I don't know what you'll think of this, but it looks to me like there's more chance for volatility because we're starting from tighter situation stocks wise to begin with, more chance for movement into the spring in the soybean market than in the corn market. So, and since we don't tend to, as you'd said, since we don't tend to store soybeans as long, that we'll know if this is going to happen probably the next, well, October, November reports, maybe delayed till the January numbers, but we'll see. And that'll help people if they have more shorter terms. I would think that if we store from now until out into for 1 or 2 months, basically to get to November, last set of USDA numbers that'll be reported this calendar year, to see if this lower yield comes about, then that'll have a lot to say about whether any longer term storage for beans occur or not. But that puts us into probably short term commercial storage, and that type of price difference would cover short term commercial storage. And again, I'm not going to talk a lot about the world situation for beans. It's again just not a lot going on there. Brazil, largest exporter, the U.S. second largest. Brazil, 60% of world soybean exports, U.S. 24. So Brazil sends it out the door via ship. That's what it does. And the United States, with the U.S., we're processing more through biofuels internally than our exports. China, the big player in terms of buying soybeans, projected this year buy 60% of the world's soybeans. So the 60% buyer of soybeans is not coming to the U.S. It's all these other smaller buyers that are coming in, and we value every one of them, no doubt. But when China goes elsewhere, then that affects our competitive standing. Okay, let's take a quick, and we'll finish up quickly here with wheat. And I deliberately not saying much on wheat because so much could change with this report coming out on Tuesday on the small grains annual summary. But just quickly, 511 and a half projected price for, well, the price for futures yesterday, and I just looked here on the side, not a lot of change. And on today's market, again, just hanging above $5. We've at times here of late since June, if we get near an RSI of 50, that's a good day, because we've had such a downtrend, and the conundrum on this is that this hardwood winter wheat, the futures are falling, and oh yes, by the way, we've got gangbusters exports going on. So I'm trying to figure that out exactly. I think I know what's going on, but got long-term downtrend. Hard red winter wheat again, just to around $5. Where we come at from 1 or 2 years ago. Again, Russia, etc. So it just brings up the issue, and that if Russia does not have the supplies, or if a drought has got them, if their production issues are crippled by 25% interest rates, then what happens in the soybean market? Because Russia is the number one seller of soybeans in the world. If they can't come to the market, then and what they sell competes with U.S. hard red winter wheat. And oh yes, by the way, U.S. hard red winter wheat in the USA projected 210 million bushels of hard red winter wheat exports in this marketing year. I think it was in June and July we went to 275. In August we went to 300, and this is only for hard red winter wheat. And then in the September report, the USDA raised hard red winter wheat to 300 million. I think it's, pardon me, now it's 325, and that was the only category for U.S. wheat exports that changed. So I think there are signals here that buyers, as they look around, they're not that confident in Russia staying strong in the market, and that's probably a positive. Well, it's a positive for movement, but we've got such a massive wheat that the cash prices aren't showing it to any degree, which is a conundrum and sort of frustrating. So, and net position of traders, negative, spec traders, strongly negative again, a little bit of positive here of late. And the USDA is projecting 510. So in this case, the USDA is projecting $5.10 a bushel, and the futures are bearish. They're about 470. So with that, we're on 5 minutes past time, and like I say, I think that the wheat market has such potential for change with this small grains summary report coming up that I'll kind of withhold a lot of comment on that at the moment and look towards that other thing. Okay. Okay, Rich, I'm out of that. We have
Yeah,
a
we had one comment. Someone noted Pinion's commentary Monday was that reduced exports of Mexican feeder cattle might be a plus for corn because it would imply greater sales of corn to Mexico.
Yeah, yep. And that's consistent with the discussions on the side that we've had if they can't bring the feeder cattle across the border, well, they'll just feed them south of the border and send the beef over. So,
Folks, if you have other questions, either in the Q&A or the chat, those are both down at the bottom of the Zoom window for most folks. So you can click on that and put something in there for us.
And Mark, I want to ask you a question. So after you saw what I'd gone through in terms of ideas on the direction of the market, does that have any impact or any further thoughts on this, on where that'll put us in terms of cash sales at harvest as opposed to storage going forward?
Well, I think the only thing I would throw in there is that the overall fundamentals, carrying futures, current basis, all suggest, they're all telling us store, store, store. The question, I guess, comes down to, how do I want to store it? Where do I want to store it? These kind of things. And I liked your thought there and hearing that about, let's see here, I'll keep that on, but getting that maybe we could have more volatility in soybeans, and that might have a bigger impact, even to the point of, hey, that might cover commercial storage at least for a while. Because again, I think for a lot of folks, it's like, okay, the market is telling us store. So, but what if I only have so much capacity? Again, I'd argue my on farm, let's stick it on the farm, right? Use corn, grain, put my feed grains in the bin at home. But your comments on the volatility suggest, hey, yeah, let's go ahead and keep it in there, and let's not be a rush to make those sales on the soybean side if I've got some soybeans too. And that sure made a lot of sense.
Well, and I think, and with this comment, you'll probably strangle me for what I'm about to say, Mark. So keep your picture up if you would. That if the market has a narrative where it's saying store, then that tends to drive the price, the future prices, and whatever bids we have towards break even. So it's to me, it was really interesting to see that your numbers on commercial were showing that break even at best, and even on some of the cash. Again, and pretty heavy dependence on our assumption about basis levels, of course. But but the futures, if they're all convinced that we're going to be that storage is going to be the thing, then I think we should be wary that, hey, that's where they're pricing this thing. They'll tend to drive it towards break even, which should be
So,
better than losing to the market for sure. But
right. So
anyway,
you're saying that then, that, hey, it's driving us to that. Could we see futures fall then?
it could go either way.
Oh,
If we probably drive up futures to cover those storage costs, because we have people buy, or if they go and do storage hedges, we're selling right on the
right.
farm. And if buyers on the other side, there are people that at least the specs will be on the other side of those transactions. So anyway, I'm not doing that to undermine anything we've said here, but now the market's attention once we solidify the production numbers and get the supplies figured out, we're going to turn our attention to usage and storage, and that's going to be really interesting to see how that plays out.
Quick question for you then too is, let's say we start seeing, um, I mean, like I said, the market is expecting a couple bushels off on both corn and the
Yeah,
soybeans.
I
Let's
think
say we
that's
see
right.
that, or even something more dramatic, or not incredibly significant, but we do see a reduction. Will that impact futures more, or will that impact basis? Will we
Um,
see basis widen? Because it could bounce up futures because, oh my gosh, it's shorter, so futures go up. What's that going to do to, will basis widen, do you believe, or
I,
will that
I,
drive cash too
well,
in Kansas?
my first response, my thought on that would be that even if we're only 184 bushels an acre, we're still 16 plus billion bushels of corn. We're still going to have a whole bunch of corn. So I don't think that will drive people to worry, on the feed grain side. Uh, but but we would, especially with the bioenergy issues coming into play on the soybean side. If we shave a bushel and a half off the soybean side, then and suddenly you're at 200 million bushels, and it's getting tight. So that comes back to that issue we were just talking about earlier with regard to this the bigger yield question on the soybean side. And we saw the maps. It's been dry
Yeah.
in the key Central Eastern Corn Belt states. So if the soybean yield drops another bushel to a bushel and a half, then I think there's more opportunity. If I remember your question right, more opportunity for prices to respond. So that's my issue. I just think there's more uncertainty on the soybean side, more at risk because we're not that far from being pretty tight, and more opportunity for volatility on the bean side.
But would the impact on prices be equal to futures and cash? So will
Oh
they
yeah.
both will still maintain that same basis, or will futures bounce up and cause basis to widen more?
You smoked me out here.
And
You
I
asked me
guess,
a tough
and
you
see,
asked me a tough question, and I answered the one I wanted to answer, and not yours. I think on the corn side, that basis wouldn't be affected that much because we have so many local supplies. But on the bean side, I think both basis, and I think they both be affected because you'd be worrying local users, uh, and that on the bean side, if we do see that type of move. So I think both the futures and the cash would be impact on the beans, but I'm not on the corn. I think it'd be more futures than than the cash basis, just because
that would
of
make sense to
abundant
me.
supplies.
I think that makes sense to me, that because yeah, we're only going to be able to feed so much. The ethanol plants are going. Some of this, oilseed demand domestically still is kind of sometimes predicated on plants that are going to get built or get expanded. And the RFS isn't done. We don't have 45Z nailed down yet. We don't know where all these things are going to come.
It's
But
policy,
again,
man.
the volatility in the soybeans, I agree with you, is much
Yeah,
tighter. So I think it's
yeah.
a great point.
Well, I'm not Rich. If we don't have any other questions, Mark, I just want to thank you so much for working with us on this. It's been a pleasure, and really been a great help for us. So thank you.
It has definitely been my pleasure. So thank you guys.
You bet.
And thank you both for the stuff today. We appreciate it, folks. This is kind of the end of what we're doing for 2025. We'll be back the first of next year, although it's possible we could decide to do something along the way, so keep an eye out. Dan and Mark, thank you, and we'll shut her down for today.
Thank you all.